Yeah, and it looks like our friend Derek up in Granby was asking you to send some snow up to
Yeah,
Grand County.
happy to do that if I could. Pack my suitcase and go. I think I'd probably need a very robust Yeti cooler to keep it cold.
Yeah, I can hear you on that. Okay. Well, we still have a few people joining, but good morning, everybody. Uh, Ben Mendenhall, the administrator for the Centennial State Liquid Investment Pool, on behalf of our Board of Trustees. We are approaching our 2-year anniversary, which is fantastic. And we appreciate everybody joining today for an update on the fixed income markets. And as usual, we're going to keep this in more of a podcast format. And if you have questions, feel free to save them to the end, or if you want to put them in the chat, Will and I can address them in real time, whatever works best for you. And with that, I'm going to hand you over to Mr. Goldthwait, who is our client portfolio manager for State Street, and he can give you a brief overview of his background, and we'll get going.
Yeah, that's awesome, Ben. So thanks for having me, Will Goldthwait, State Street Investment Management. I've been here for 11 years, came from both the sell side at two different investment banks, and then I was a portfolio manager for short-term cash and liquidity funds prior to that. So loving my current job where I get to sit between the portfolio managers and our relationship managers and talk to folks like you. Ben, I realized that I have to just read a quick disclaimer. Almost forgot about that. So let me just get the compliance folks satisfied here. Before we get started, I must let you know that the information on this webinar is intended for the confidential use of both CSLIP clients and prospects, as well as State Street clients and prospects. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by Ben and me are our opinions and not do not constitute investment advice, nor should be relied on as such. We are recording this at 10 a.m. Mountain Time on February 17th, 2026. Sorry about that, Ben. But I my compliance people would not be happy if I didn't read that off.
No, it's okay, Will. And it's we're very fortunate to have the powerhouse that is your team as the investment advisor for CSLIP, being the global cash team at State Street Investment Management. So we understand that there's a lot of disclaimers that come with that. So you ready to get kicked off here, buddy?
Yeah, let's do it.
All right. Well, let's just kind of talk about what's at the top of mind for treasury teams and cash teams such as yourself.
Yeah, absolutely. I think top of mind right now, and I think the story will fade as we go through the year, but Fed independence. Excuse me, Fed independence has been something that's been absolute top of the conversation pool, and we've been spending a lot of time on it. Obviously, Kevin Warsh now the incoming chair-elect. Excuse me, got a little tickle in the throat. And we feel as though his nomination, or should I say confirmation, will be relatively routine. And also, I think it's worthwhile just to spend a minute or two on the independence, or what I view as the very stable independence of the Fed. I think it's worthwhile to remember the Fed is a 100-plus-year-old institution founded in 1913, and their process and their goals and their mandates have been legislated by Congress. And I think that's a really important thing to keep in mind as we think about the Fed and their independence, is this is an institution that was created by the government, created through a legislative process, and there was a lot of hand wringing back and forth and whether they should even have a central bank. And first talks of creating a central bank were as early as 1900 or even as early as 1890. And ultimately, the Fed was not created until 1913, and we were late in that game. There was many European countries, Bank of England being most notable, that had been around for a while. So I think it's important to note that there's a couple things that I think are really important. First of all, the Fed Treasury Accord created in 1951 told the Fed through an act of Congress that they needed to be focused on price stability in the economy. No longer was their job to keep rates suppressed to pay for the war bonds that had to be issued during World War II, and that they were now free and clear to act independently on monetary policy. Then again, in 1977, there was another act of Congress that gave them a dual mandate, price stability and employment, full employment. So I highlight those two things because this is something that the Fed feels very strongly about. You can see Jay Powell references that in his press conferences when he's pushed on the topic. And so, in my opinion, there's no one president that is going to be able to change that unless they go through a proper legislative process that says this is your new mandate. And I just think that that's a really important thing to highlight for this audience to know that not only is it a very, very strong institution, but it's a very strong institution that's comprised of 12 people that vote on monetary policy. It's not one person. So Kevin Warsh might have said all the right things to the president to get nominated for this post. But I think he understands, recognizes, and appreciates that. So I just want to say to the audience now that my personal view is that we will have a very independent Fed and that that Fed will do the right thing by this economy. So that's I think something that we really need to emphasize, Ben.
Okay. Excellent. Well, and thank you for that. I think that that's, a big topic right now. So economic data. It
Yeah,
seems that everything's kind of all over the place right now. A lot of crosswinds, a lot of headwinds, a lot of tailwinds. What are you seeing? What's going on?
yeah, yeah. There's a great podcast out now by our company. It's called Street Signals, and it the host of that podcast, Tim Graff, interviews our chief economist, Simona Makuta, and she talks about a lot of these economic crosswinds. And so, what is going on with inflation? What's going on with labor? There's a lot of conflicting messages out there. So is the labor market weak? Is the labor market strong? What is going on with inflation? Is inflation on the rise? Is inflation on the fall? And so there's absolutely a lot of crosswinds out there. Our view is that the temporary tariff impulse on goods inflation is just that, it's temporary. We note that both rents and labor inflation, so employment cost index, hourly earnings, are trending lower. And I'll talk about the job market in just a second. But with that in place, we do see this temporary impulse in inflation as being just that temporary, and that we see the long-term trend moving towards the Fed's goal of 2%. So now, a lot of people I know are listening right now and being like, "Are you kidding me?" It still hurts when I go to the supermarket. I look at my, electricity bill. I just got my winter heating bill. Like, there's a lot of things out there in the economy that are painful right now, and I get it, and I totally get it. Those things are not going to change. Prices are not going to fall, but the change of the prices is going to gravitate towards that 2%. So the year over year, month over month changes in those prices is going to start to gravitate. There's definitely stickiness, right? And so if we looked at that time period from 2009 until 2019, inflation was running under the 2%. It was running at about 1.7 annualized rate in core PCE. When we look at the period from 2020 to where we are, we're running over, right? So there is it, you can't land the plane exactly where on that 2% number, right? There's going to be some over under. So I think ultimately Fed policy will be more restrictive. But ultimately we're going to trend there from an inflationary standpoint. Not to say the prices are not going to go down, they're not, but it's just a change of prices. And that's what we're really looking for, price stability. Okay, so then begs the question about the labor market. And everyone's like, AI is going to, take all the jobs, like the labor market's weakening. And yes, I agree that those headlines are scary, but we're just not seeing it in the data. So we're seeing an unemployment rate that is still, I mean, the latest unemployment rate ticked lower. The latest underemployment rate um, ticked lower, which is the U6 number. There's U3, which is the unemployment rate, and then the underemployment rate is the U6 number. That ticked lower as well. We're not seeing jobless claims tick higher, but we are seeing overall the average 3-month average, which is the number that the Fed looks like, of non-farm payroll gains is trending lower.
Mm.
And there's a lot of anecdotal evidence out there that says hiring is slowing, job postings are slowing. And so then you push back and say, well, the reason the unemployment rate is low and because the and jobless claims are low is because the supply of labor has been dramatically reduced. And that's absolutely true. Immigration has essentially been sealed off, right? There's very, very low levels of immigration now. And we've got a big demographic that's leaving the labor force, and that's the boomers, right? It's a a 70 million person contingent of the labor force that's all but graduating out of that labor force. So absolutely, and this is what makes that market very confusing. You've got low supply, but low demand. And so the Fed recognizes this, and that's why, Ben, our call for this year is that the Fed needs to continue to cut rates. Because as much as the certain data might not seem like the labor market is weakening, we think the labor market is weakening, and we think the Fed needs to cut interest rates.
Excellent. And, I think that that's great context. And the question of all questions, what's the rate cut forecast? Since you think
hmm
that the Fed needs to cut rates, what's State Street's opinion on that?
Yeah. So our chief economist, Simona, and I'll forward around our forecast for 2026, and you can share it with those that are on the call. But her forecast for this year is that they will cut rates by 25 basis points in the second, 25 basis points in the third, and 25 basis points in the fourth quarter of this year. So a
Wow.
total of 75 basis points um, each quarter, starting in the second, third, and fourth of this year. And the reason she feels as though they need to do this is to continue to support her view, which is of 2.4% GDP growth. And we can talk a little bit about why she has that 2.4% GDP growth picture, but ultimately, she would not have that view if the Fed was not going to continue to cut rates, and she just feels strongly about that.
Yeah, no, and fair enough. I think that's the beauty of what we do is you ask five people, you're going to get five different answers, right? And just kind of a follow up to that, piquing my interest here. Can you discuss any kind of distension in the dot plot from that forecast, and where are we seeing that dot plot right now with the voting FOMC members prior to a new chair coming in?
Yeah. So the last time we got a dot plot update was December. The next one we'll get is the next meeting, which is going to be in March. And the dot plot is interesting. So we have to take the dot plot with like a huge grain of salt, maybe even like a shovel full of salt, because there's so much criticism about the dot plot. Because essentially what the dot plot is they go to a Fed governor or to a member of the FOMC and they say, okay, right now, right today, where do you think Fed funds is going to be in the next meeting, the next quarter, the next year, and then longer term, right? So it's their opinion on that day based on the information that they have at that time. So we can't think of the dot plot as being too dynamic. It's like an opinion survey, basically. And so it's one point in time. And I think that's an important thing to keep in mind as we look at. Now, when we look at that dot plot from December, we saw three dissents that were looking for policy rate to be lowered. But we also, sorry, one dissent to lower more than 25 basis points. So that was Mirren, who wanted a 50 basis point rate cut. The rest of the committee voted for the 25 basis point rate cut. But then there was two that dissented and did not want any rate cut. And then there was an additional four people that give a dot, right? So there's a total of 19 people that submit dots. There's 12 on the FOMC. So those additional also put in their dot plot prediction. And they were also saying they did not want a rate cut. They did not want a 25 basis point rate cut. So it's important to think that as much as the president and the administration wants to see lower rates, there's still a lot of people on that committee or adjacent to that committee that do not think that lowering rates was the best thing to do at that December meeting, based on their dot plot forecast and based on where they thought the year would end. So that's really important to think about, because when we go back to the role of the chairman, the role of the chairman is much more of a collaborator, of a leader, than someone that's just going to go in and say, this is what I think monetary policy should be, get in line, like do it. So the way that this works is that the chairman has 2 weeks before the actual meeting. It's called the blackout period, and that's when the chairman goes around, starts making phone calls to all of the people that are going to have a vote in that meeting. So Jay Powell goes around, starts making calls to all of these different people. Hey, what's your view? How are you thinking about it? And then he tries to pull together people so they have a very healthy and robust discussion and ultimately come around to what they think the committee should propose. Now, as I've just described, there's an enormous amount of variance in economic data. There's an enormous amount of variance in what's going on in the broader economy, geopolitical effects, market effects. There's so many things. So the fact that there have only been two or three dissenters at these meetings when you've got 12 voting members is actually, maybe that's more unusual, right? Maybe the vote should be closer, right? Maybe they should be an 8-4 vote, or maybe it should be a 7-5 vote, something like that. So I think it's very interesting. It will be very interesting to watch this committee over the coming months and coming years to see how Kevin Warsh brings this committee together to formulate views, given how many cross currents there are going on in the economy. So I know that was a little bit, Ben. So maybe I got a little too excited about the FOMC process.
No, that's great. I think that you have a very unique way of delivering uncertainty with soothing sounds. So, no, that's greatly appreciated. And speaking of, soothing information, you recently published something called the Gray Swans, and it talks about, what events could trigger challenges for the markets. Can you tell us more about that? I mean, I found it interesting.
Yeah, so the gray swan, so everyone's probably familiar with this black swan idea, and that is, the right tail risk, left tail risk, something that's extreme, way out here on the distribution, probability distribution scale. And so what we chose to do is say, okay, well, what about something that's perhaps a gray swan? So something that's maybe not out at the extreme, but something that's worthwhile. And I'll put the link to the article that's up on our website, and folks can have a read. But we thought that that was an interesting thing just to create a little, thought provoke. And so I'll read off them just here for folks. And obviously, if somebody wants me to dig into any one of them, I'm happy to. But uh, the first one is AI fails to scale.
Hmm.
So we know that there's an enormous amount of capex going into AI, and what happens if it fails to scale? The next is China goes shopping. So in other words, China stops becoming a major exporter, and they start turning into more of a USA. The USA is a very closed economy because we have such a high level of consumption. What happens if China turns that way? What does that mean? Fortress of North America, this closing off of global trade. and doing the extreme of friendshoring, nearshoring, right? So fortressing of North America, oil goes to 100, right? That could be incredibly good for some industries and incredibly bad for others. The year yen carry unwind. So that is simply that the Japanese begin to repatriate a lot of their fixed income investment in the United States and bring it back to Japan. That could be very challenging for US yields, treasury yields specifically. And then sovereign warning triggers a bond shock. And that simply means that the bond market looks at the deficit spending that the United States is doing, that the UK is doing, that France is doing, that every developed market is doing. And the bond market says, you know what, guys, you're not paying us enough for this irresponsible fiscal management. And so there's yield spike higher. So those are the six gray swans, and obviously the article goes into much more detail. But I think for this audience, I think the AI fails to scale, and I think the sovereign warning triggers bond shock are two that I think are going to be very interesting. With every new technology, uh, whatever it was, let's say it's railroads, let's say it's the internet, let's say it's the canal projects of the UK in the 1840s, there's always a boom bust, always. And so we can look at any of these new technological initiatives and see that. So you would assume that AI will have some sort of a bust at some point. The thing is, we just don't know who those winners are just yet. So it's going to be very interesting to look at that.
Awesome. Well, that's, I mean, extremely helpful, in a lot of ways. And, if we can just kind of shift gears here, and I definitely want to
Yeah.
field some questions from you, but can you give us just kind of a basic overview of how State Street is managing the CSLIP portfolio, managing the credit risk within the portfolio, and namely commercial paper, and just kind of a overall allocation strategy, if you will?
Yeah, absolutely, Ben. And then I have some questions for you.
Right.
Um, So, from a portfolio perspective, we look at things in a structural, cyclical, and tactical framework. That's how we invest. So, structural are just trades that you can put in that are always just going to outperform no matter what the market cycle is. And so, a good example of that is putting asset-backed commercial paper in the portfolio. These are very solid names we like. They're 30 days to 45 days of maturity. We put them in the portfolio, and they typically always outperform the unsecured commercial paper in the portfolio. So that's a structural trade. We like that trade. If it doesn't, if the performance isn't there, we don't put it in the portfolio, right? But that's a structural trade that we really like. And then from a cyclical standpoint, we say, okay, where is the Fed going? Are they raising rates? Are they lowering rates? Right now, from a portfolio perspective, we think the next move out of the Fed, as I mentioned, is lowering rates. Therefore, we're leaning the CSLIP portfolio long duration. We're leaning at long duration. And so we've got it just a little bit long. But we also recognize there could be an inflection point. There could be a point this year where the Fed is done, right? If they do three rate cuts this year, that brings the Fed funds policy target rate range to 2.75, 3%. We think that's slightly below neutral. We think neutral is somewhere between 3% and 3.5%. And so therefore, we would then shift the portfolio to being even neutral or short duration. So cyclically right now, long duration in the portfolio. And then from a tactical standpoint, we continue to focus on the highest quality, most liquid names to put in the portfolio. Safety and liquidity is the primary objective of this strategy. So we want to deliver that yield to you in the safest way we can. And so we are always looking for rock solid, globally systemically important financial institutions, or GSIFI as they're known, names, and we put those names in the portfolio. So I think that's the thing that I want to emphasize to this audience is that we are really concentrating on the highest quality portfolio while we can deliver that alpha that you're expecting from this type of strategy. And so our yield's probably not always going to be the best, but know that we're making sure that we're preserving that yield. And then through any number of different market cycles, our yield could be the best. Really, it depends on cash flows in the portfolio and how we're thinking about it.
Yeah, no, that's great. And it's very important, for the audience that having a diversified approach for your liquidity, is best practice. It shouldn't just be focused on yield. And if you have an average between two or three funds, if fund A is yielding the highest, B is in second place, and C is in low place, then you want to look at the blended average between all three of those at the end of the year. And speaking of which, Will, you mentioned something that is really pertaining to Colorado. Traveling around the state over the last 6 months and over the last month, visiting our now 42 plus participants, which is hard to believe. In just 2 years, we're working with over 40 local governments. That's incredible. But a lot of the forecasts that I've been mentioning to um, local governments as we head into the budget cycle is 2.75% on their aggregate portfolio, between a blend between the longer term securities, if they have any, CDs, and then their liquid funds being bank deposits, money markets, and local government investment pools. So I think that, with what we've heard from you today, I'm glad to know that I'm not way off in my recommendations to these local governments on, 2.75 as a good forecasting model. So thanks for that. That's
Yeah,
firming.
yeah, absolutely, absolutely. Um, but let's pivot to that, Ben, and what are you hearing? I mean, you spend more hours on the road than long haul truckers, right? I mean, you crisscross the state of Colorado just nonstop, and so what are you hearing? What's the word out there?
Maybe I should invest in a CB radio to talk to the other people that are on the road as much as I am. Um, but no, really, there's kind of a few main themes here. Snow, lack thereof, obviously a huge problem, right? Water concerns, because of lack of snow and potential water issues. Fire, big topic. We had some rather large, and I think our state's fourth largest fire last year up in Northwest Colorado. And I think that hopefully we get the skies open up over the next 6 to 8 weeks and really deliver some much needed moisture. But one of the other themes is just kind of stagnant growth out there. A lot of municipalities are seeing anywhere from 1 to 2% increase in their sales tax revenues and or their budgets, and that is kind of the average around the state. There are outliers on the positive and the negative side, and I think that a lot of the resort communities, from what we're hearing, up in the summits, the Eagles, the Gunnison and San Juan region, where a lot of our mountains that you've heard of, are, it's, I think they're really starting to forecast and project down on their budgets and project down on their sales tax revenues. We don't have a lot of the December's numbers yet. They're starting to come out. January, is going to be probably out there here soon. So I think that really with this slowdown, um, that's really what's on people's minds right now. And the age old issue around Colorado of housing. Housing continues to be a problem. And I think it's a double-edged sword because you have interest earnings going down, but then you also have the cost of borrowing going down. And from what we're hearing from some of our municipal advisors, our investment bankers, as well as our custodial banks, is that there has been a kind of a logjam of debt issuances through the fourth quarter and into the first quarter of this year. A lot of the issuances last year were up anywhere from 25 to 27%. A lot of these professionals seem to think that we're going to remain below that threshold of last year, kind of in that 15 to 20%, but a lot of that remains to be seen. I do think that as rates tend to move lower, there will be a lot more demand out there to get these projects done. But finding reliable employees that are within proximity to a certain community, whether it's Eastern Plains, I mean, this is a statewide issue. And then having housing for these individuals is, I think, very on the top of mind right now. And then also, what's going to happen as we head into the next assessment cycle? Are we going to see significant property tax increases? Are we going to see any flat property tax valuations from the assessors? What we're hearing out there is kind of the statewide average expected for an increase in or in property taxes right around 5%. And compared to the last assessment 3 years ago, I think that that's kind of a welcome change. But then again, there were some adjustments on both the residential and commercial components of those calculations. So I think that, Colorado, what we've seen from some of the data from the University of Colorado is that we are starting to regress towards the mean. We're not in the top 10 anymore of growth states, whether it's economically, population, et cetera. We're now kind of in the middle of the pack. And, we've been predicting that for about 2 to 3 years now, at least personally I have, because Colorado had a really long run of a boom, as you mentioned. So I think that, with the level of uncertainty out there and a very slow winter from not only a tourism, but also a moisture standpoint, we may be in for a little bit of a rough ride over the next kind of 6 to 12 months. But in terms of a state recession, I don't see that happening. And it sounds like, on the federal level, on the national level, that recession isn't too much of a concern. So I think that, really weathering the storm is a good approach. And again, being conservative on forecasts, whether it's budget growth, sales tax growth, investment earnings, really being conservative and focusing on over promising or I'm sorry, over delivering and under promising,
Yeah.
essentially when you're reporting to your councils as well as your board of county commissioners or board of directors. So that kind of gives you, I'm happy to drill down. There are some regional issues, but that kind of gives you a snapshot of what's happening around the state.
Yeah, no, that's super interesting to me, and I will just complement that by saying we are hearing that from municipal treasurers really nationwide. There's a lot of angst over the high cost of things. There's a lot of challenges around revenue, sources of revenue meeting those higher costs, particularly in the construction sector. Looking around at all of the infrastructure that's being built is really impressive. Oh, there we go. Sorry. So yeah, this is a nationwide challenge, and the housing challenge is a nationwide challenge. Now, one thing that is interesting is we're starting to see a little bit of relief in rents. Um, but that is, could be. I guess the other thing, Ben, I think about in the context of Colorado is as the one big beautiful bill gets rolled out, and as we know that there's so much stimulus in that bill, and so many things that want to be stimulative for the economy, are you seeing, anything specific like that amongst municipalities? Like, in other words, is there a particular sector that is saying, oh, this is an opportunity for me now to be able to do something?
That's a great question. Really, it was discussed on the CU economic forecast in terms of us having concrete data from individual municipalities and county treasurers, et cetera. We haven't heard a lot of chatter on that. I think that, at least here in Colorado, the implications of the big beautiful bill are yet to be seen. So it remains relatively kind of an anomaly out there of what impact is this going to have? Is it going to create more opportunities, from a funding standpoint? I know that the government shutdown at the end of the year really hurt grant payments, right? And distribution of funds to local governments, namely here in Colorado, primarily around the Front Range, but there was some Eastern Plains and mountain communities that were affected by that shutdown as well. I mean, I guess not to, flip the question around, but, what have you been hearing out there, given that you guys do serve as investment advisor for another local government investment pool? What do you hear?
Yeah, no, we're hearing that there's just so much caution. And even I think one of the things that's been very interesting to observe is even with the euphoria that 2025 started with, thinking this was going to be such a pro-growth, such an expansionary administration, and that the spending taps would be opened up, and that all of a sudden everyone would be like, go, go, go. And then all of a sudden the tariff noise created a lot of confusion. And so people started to pull back. And then all of a sudden, business leaders, community leaders start to say, okay, there's just too much uncertainty. And we look at a particular uncertainty index, and that spiked to an all-time high. I mean, as long as that index has been around, it was an all-time high, which I found was just so interesting. even through the financial crisis, we hadn't seen the level of uncertainty as high as it was just on these tariff news, on this tariff news. So that's something that I think continues to permeate. And then add the geopolitical thing in, and a lot of folks are just hunkering down, holding cash. We just had a catch-up call with a gentleman named Peter Crane, who's in charge of Crane Data, which is something that oversees a lot of SEC registered money market mutual funds. And they've seen 20% growth in those SEC registered money market mutual funds over the last several years. And I think it's a testimony to the uncertainty that's out there. People just continue to hold cash, and people continue to be cautious on how to deploy that cash.
Yeah, no, that's great. Another resource that I feel like I should mention to the audience here is the Public Funds Investment Institute, which is pubfunds.org. Marty Margolis puts out some great research and some data, not only for money market funds, but local government investment pools, and kind of a yield dashboard that's really helpful. So I did want to mention that to the group. Um, and do you have any other Colorado specific questions? I have a few updates, on progress for the audience, but what else do you have for me? We do want to leave some
Um,
time for questions
I
here.
did have some questions, Ben, but I think you've covered those questions. Let me just look at my notes here. Yeah, we talked about some of the biggest challenges facing the different regions of the state. We talked about the light snow, municipalities managing some of the lighter attendance around the mountains. That's been a challenge. You talked about the fire risk. You've answered my questions before I could ask them. Well done.
Well, I guess I'm learning from you, learning from the best, right? So no, thanks for that. And I think it's been a really exciting couple of years for us here, to go from 5 participants when we started up to 42. I think that's phenomenal. With your team's strategy on the portfolio, we're happy to report that we have crossed 520 million as of last Friday, which I think is a great testament to a lot of local governments seeing the value in the education and the information, as well as the resources that you provide. So we're not just an investment fund. It is available for debt proceeds as well. So we want to thank all of our participants. We do have a couple of board members on the webinar today, and we're really focused on providing that high level of value statewide, not just here on the I-70 or I-25 corridors. We really want to make sure that we're providing a high level of service. So I would encourage people to reach out if you have questions. We have 70 years combined experience of our team here in Denver. We are very local. We understand the state at a high level, as I think all of you have seen today. So that's kind of the brief updates I have for you. And I wanted to open it up to the audience. We know that people can be relatively timid on speaking. So if you want to put a question into the chat, we can address that. Or if you want to unmute yourself and ask Will or myself some questions, we greatly appreciate the interaction. But we will focus on doing another one of these, every 8 weeks or so has kind of been our cadence to keep you updated. There's a point where we can do too many or too little. So that's kind of where we're focusing, but we're always open to suggestions for next topics, all of that. So hopefully we won't get an awkward silence, but we wanted to see if anybody from the audience has any questions or would want to share some challenges that they're seeing in their neck of the woods. So we'll open it
And
up for
and
the.
Ben, while people are unmuting themselves, I'll just put in the chat. I just put in the six gray swans, so people can have access to that if they want to dig in a little bit.
Great, great. Thanks for that, Will. And if you need to know where to access the chat, just go to the bottom of your Zoom screen and hit the chat button. And yeah. Okay, so we got a message here. Sorry, let's see. Would you mind summarizing how you get to the 2.75 expected rate of return? Great question. So right now, with where the Fed funds rate is, as well as with Will's and State Street's forecast of 3 rate cuts, if right now the average return on liquid investments and in the slightly inverted yield curve favoring towards cash that we are starting to see normalize out. The 2.75 for an aggregate of all of your longer term securities as well as CDs is really a good forecasting model for a couple of reasons. One, it factors in 3 rate cuts. So if we do see the Fed lower Fed funds by 75 basis points, then you'll be right around the 3% in change range. And as Will mentioned, we may not see that third rate cut into the fourth quarter. So you'll probably still have a lot of accumulated interest through the first 6 months of the year. But this is a way of protecting what your forecast is to city council, to your board of directors, to county commissioners, finance teams, and constituents. I think that if you put that number in, you're really going to be protecting yourself again against those rate decreases, but also any possible fluctuations with longer term securities out there. So it's just kind of a good measure. If you want to be a little bit more aggressive, you could put 3%. But much like State Street and Will's team, I always err on the side of conservatism and caution. So that's kind of where we came up with the 275 forecast for local governments. Happy to expand on that, but that's a great question and well received. Okay, and then we have another question in here. At what level of assets under management can pool participants expect to see a reduction in the expense ratio? Great question. So when CSLIP started, we were at 26 basis points due to our legal fees, filing fees, S&P, as well as service providers with a very small asset base. And after the first fiscal year, we were able to lower that expense ratio down to 18 basis points with a consolidation of some service providers and kind of renegotiating the costs to the fund. And it's very important to note that the yield that you see on our website is net of the expense ratio. So right now, with CSLIP operating at a targeted 16 basis point expense ratio, that includes the management fee from State Street, the administration fee from our little firm in Denver, the custodial fees, and then the board reserves some expense ratio for legal fees, et cetera, and board expenses. So we do expect that we're going to remain relatively close to 16 basis points, at least for the next couple of months, but we were able to renegotiate our custodial agreement with the current custodian, and we're going to see a decrease in the actual custodian fees, not a whole lot, but slightly. There is a chance that we could get into the 15 basis point ratio probably in the second half of the year, but a lot of that depends on participation levels, contributions into the fund, and being able to manage that expense ratio effectively. But we're right in line with the other local government investment pools, the exact same as one of them, a little cheaper than another one, and one about 4 basis points behind in expense ratio from the leader out there. So we're very competitive, and that's a great question because the expense ratio really does drive a lot of the yield to the participants. But the good news is that we've been coming down since inception from 26 to 16, and there's a chance that we could hit 15 towards the end of this year. But a lot of that is factors that are out of our control. But we will keep you posted with those monthly newsletters that we send out. We're happy to address any questions. Our team in Denver, again, is very local government focused from our operations team. We do have a former local government CPA on our team, so there's a lot of resources that can come your way. Feel free to reach out to us. We're happy to review and address any questions, but that's a fantastic question, and hopefully that answered that. Okay, and we've got a question from Northwest Colorado, which is always great to see. How does the price of gold and silver play into your predictions for the next 6 months? Will, that is on you, buddy.
Yep, absolutely. So my own opinion is that gold is in somewhat of a bubble right now. We've seen a significant amount of retail demand that has come on the follow of significant amount of central bank demand. So we know that China was out stockpiling gold. We know that Russia had been before. We know that there's been significant accumulation of gold by certain countries. And frankly, in China's case, it was a hedge against owning too many treasuries. And so that started a sort of gold bull run. Then retail got involved. And so now it just feels as though it's getting a little toppy. And I don't know if there's anything truly fundamental under the demand for gold at this stage in its rally. And I would just silver sort of follow that generally, right? We know that it's not an exact correlation, but I think it's from a precious metal standpoint, it's highly correlated. So when I think about what that means over the next 6 months, is this is kind of fits into our view about being cautious on credit. Arguably, is gold credit? No, it's a commodity, it's a precious metal, but it has had such an incredible um, run from a price appreciation standpoint. It just feels like anything that runs that fast, I just get nervous. When you see charts that go sort of straight up and to the right, I just get a little nervous that things have been overdone. And so we would be just cautious on that sector. I would be cautious on that sector right now, as well as fitting into cautious on credit as well.
Right. No, I think that's very helpful. Um, okay. So another question related around the expense ratio at 15, is that the lowest that we can ever reasonably expect? That is a great question. To add some more context onto that, really that decision comes down to the Board of Trustees. The underlying service provider contracts are really the primary driver of that expense ratio, being the portfolio management fee from State Street, our administrative fee from Centennial Government Advisors, and the custodian. Those contracts are usually 3 to 5 year contracts and are set at that fee ratio until expiration. And there's always a renegotiation at that standpoint. But the 2 basis points that the Board of Trustees reserves for Board of Trustee expenses as the portfolio grows, they may not need to withhold 2 basis points for legal fees, filing fees, insurance, website, operating system, et cetera. So as the portfolio assets grow, currently from 520 million and change, the board may elect to withhold less. So there is a chance that that expense ratio could go down into the 14 based off of where the expenses are of the fund and a board determination, which again, our board of trustees, you can view on cslip.org. They're all local government finance officers like yourself, representing every type of local government in Colorado and widely spread out around the state, not just front range focused. But having said that, those are really kind of the big determining factors, and we could see a reduction in that expense ratio as the assets grow. So I would really encourage the local governments on the phone to reach out to us and find out how CSLIP can add value. That's just not just yield. There's a lot of different ways that our team with 70 years of experience and one of the top cash managers on the planet being State Street can help you out. So hopefully that addresses that question. Another great question. Is there any other questions from the audience? I know we're a few minutes over here, but we want to, this webinar is for you and this podcast is for you. So feel free to fire away. And if we don't see any other questions coming in or any mute buttons coming off, then we'll schedule a date for our next webinar, which again will probably be in 8 weeks or so. And if you have ideas for topics, you can definitely reach out. Okay, let's see. Okay, so there was another kind of statement here. It says the understanding is that it took the state's largest pool well over 10 years to reach 1 billion in assets under management. CSLIP is over a billion in just over 18 months. How did we do that? Well, I think it's a big testament to our board. I think it's a testament to the administration team here in Denver, having 70 years combined experience, as well as to State Street and really providing another option for local governments. Diversification is key. The top local government investment pool in Colorado has anywhere from 15 to 16 billion in assets. And when you look at the total liquid assets in Colorado between bank deposits and local government investment pools, that number does float, but it's right around 44 billion. So that's one fund, almost half of the state's liquid assets. So I think that having another diversification option is key. And I think that also what's really stimulated our growth, and again, a great question, is really focus on transparency. You can see all of our portfolio holdings on the website. You can see everything about our fund. We don't make you reach out to access the data that's critical for your decision making, but also, really having these educational focused opportunities for these local governments to learn, as well as my team here in Denver being free resources for these local governments, and whether that's cash flow analysis, debt analysis, investment policy reviews, really providing value focusing on providing value to your local governments as opposed to just a transaction, which, my opinion is this industry has moved away from that over the last couple of years. So really focusing on participants, I think, is what has got CSLIP up to $500 million in 18 months, where the largest one in Colorado, to this question's point, took 10 years to get to $1 billion. So that's a big thank you to all the local governments out there that have put their trust and confidence into CSLIP as a liquidity option for their local governments on the debt and investment side. Hey, do we have any others? Any other questions? Any other thoughts? Um, all right. A very big thank you, Will, to us from Grand County, which we'll be seeing them soon. You know who you are. So thank you for that. And look, if you have questions, feel free to reach out. We'll be sending out a thank you email here shortly, and I'll see if I can put Will's gray swans into that email for you to view. But feel free to reach out to us anytime, and we look forward to having you on the next webinar/podcast. So, Will, thank you.
Thank you, Ben. Great to be here.
All
All
right,
right.
sir.
See you later.
Have a
Bye.
great day. Bye bye.